Hello everybody, it's Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Virus Turns. Yes, it's turning our housing market upside down. A lot of chaos going on, a lot of unknowns we're entering into right now. This is kind of a very weird situation that we're all dealing with. So again, I just want to hope everyone is doing well in their self-quarantining, their self-isolation, doing well, trying to keep social distancing going on and not going out unless you have to. Clearly, we've figured out that the less contact we have with people, the quicker this is going to stop spreading at the rate it's going at this point in time. So today is April the 7th. I really wanted to focus on today about sort of what's dominating the news wires with respect to the virus and the mortgage. And it really boils down to the fact that we don't really know what's going to happen with the potential volume of foreclosures that are going to be hitting coming our way. I think it's going to be massive. I think it's going to dwarf the last housing crisis for a number of reasons we'll get into right now. First of all, if you're not already a subscriber, please help my channel grow. Click the bottom right button on the video and subscribe to my channel. Thank you very much. All right, as I mentioned, today is the Tuesday the 7th of April. This is like my fifth take trying to do this video because quite frankly I just didn't convey or wasn't conveying my thoughts on this appropriately. So we're going to do it again. All right. So you don't get to see the outtakes like I do. And let me tell you, it's a little frustrating these days. So ultimately, this is just some examples of the news headlines that dominate the news. So mortgage industry could face complete chaos. All right. CNBC reported that coalition of mortgage leaders sent a request to federal regulators over the weekend. Desperately needed cash. Why? Because the forbearance requests are coming in at an alarming rate, but the servicers still need to pay the bondholders. So this is the situation that we're going to find ourselves in. This is why we're going to see probably some more bailouts going on and some lenders actually going under, because the servicing companies need to get the revenue from the homeowners, their clients, to pay the bondholders that hold the mortgage-backed securities. Okay, that's how that kind of actually works. And at this point in time, if there's no money coming in, then there's no money going out. They can't pay. There's going to have some issues. Now, the issue, of course, is we can't anticipate, or nobody could anticipate, the number of or the potential volume of this happening right now. And that, I think, is your number one issue. Coronavirus could halt mortgage payments. The chief economists at Moody's Analytics estimate that as many as 30% of Americans with home loans, that's nearly 15 million households, could stop paying their loans if the economy is closed through the summertime. So that's a significant amount of people who will stop paying their loans, thus the liquidity issues for the banks and servicing companies. All right. So basically, this is an unprecedented event, said Susan Wachter, the professor of real estate and finance at the Wharton School at the University of Pennsylvania. The great financial crisis happened over a number of years. This is happening in a matter of months or a matter of weeks. And she makes a very, very good point, because if you take a look at the last housing crisis, now, personally, I like to always draw parallels as to what happened over 10 years ago as to where we are now. I feel very comfortable in my reasoning and the reasons I believe that a lot of stuff is repeating it's repetitive. What happened back then is happening now. The difference is there has to be the event or the situation that pushes us over the edge. The virus is what's doing that right now. This is going to happen at some point in time. The virus just accelerates everything at warp speed to what's going on. That's the situation we're in. But if you recall the last housing crisis, 2007, some crumblings, 8, 9, 10 was the subprime, loans going under, that mortgage meltdown crisis, the cash out refis, a whole bit and everything. But it took about, 2007, 8 to about 2012 for it all to sort of play out. And then the recovery started after that. So their trough was in 2008. That was about a 4.5, 5-year process. Her point, which I agree with, is that this is happening now. It's happening quick. We're going to see, in a matter of 2 weeks, we saw 10 million people file for unemployment. What's going to happen next week? What's going to happen the week after? Where are we going to go with this? So this, I think, is much worse, much more difficult for the future. So that's, and nobody has any sense on how long it's going to last. That's the whole point. I do see a lot of videos and a lot of reports out there, just media stuff saying, hey, if we're out of this in a month or 2 months, that everything's going to be great. We're going to bounce back. We're going to have a crap second and third quarter, but fourth quarter, it'll be booming. Well, I don't think that's going to work that way, to be quite honest with you. I think a lot of things that are going on now will take longer to recover than we really believe. Okay, mortgage defaults could pile up at a pace that dwarfs 2008. This is an article from Bloomberg. Basically the same thing that was just sort of said here, just spun a little differently. Basically, again, we're looking at, we could see, if we already have a record 10 million job claims and we have all this non-payments for mortgages that can go as 180 days or even longer, how will this impact the environment? The environment's going to get crushed, and the mortgages are going to get crushed, and housing is going to have some issues, albeit there's always something good that comes out of this for people. But in the end, a lot of people are going to have what they say are $16 trillion U.S. mortgage market rattles Wall Street. You're darn right it does. So again, 30% of Americans with home loans, about 15 million people, could stop paying, and that would be sheer chaos for what's going on. The government has to find a way to prevent foreclosures, which could mean forgiving some debt. The chief economist at LendingTree said, the risks of allowing foreclosures are too great because it would damage financial markets that could reinfect the economy. So we're basically going to see a lot of stuff that, a lot of stuff play out. Where groups of, Bank of America has allowed 50,000 mortgage customers to defer payments. I know that, I think it was Quicken Loans said they've already had 80,000 people. So that number is just going to grow and grow and grow. It's going to get out of control. Again, talking about this, here comes the next crisis. Up to 30% of all mortgages will default in the biggest wave of delinquencies in history. So ultimately, that's what they're referring to, that one lady who's from the Wharton School of Business. The great financial crisis happened over a number of years. This is happening in a matter of months and a matter of weeks. So really, mortgage lenders are preparing for the biggest wave of delinquencies in history. And I guess ultimately they're saying that mass foreclosures and mortgage market mayhem are on the way. So I'm not going to bore you with the minutiae of all this, but ultimately in the end, if a large percentage of the servicing book, let's say 20 to 30% of clients you take care of, don't have the ability to make a payment for 6 months, most servicers will not have the capital needed to cover those payments. That's going to be the issue. So when you have, and these numbers seem to make sense. If you got 10 to 15 million people who will be out of jobs, not all of them are going to have mortgages, but when you start taking percentages, that could hurt a lot of banks and a lot of servicing companies and cause liquidity issues, et cetera, et cetera. So that's going to be the problem we're going to be dealing with. So that's really our focus in the next little while. Just for fun here, we want to talk about the number of homes taken off the market doubles due to coronavirus. So basically, in the midst of record high unemployment claims and economic uncertainty, supply is declining now more than ever on the home sales front. According to a report from Redfin, as homeowners are staying put and retracting their listings. So there was a 148% year-over-year increase in homes being delisted during the week ending March 29th, coming to a total of 28,000 plus homes pulled off the market, the report from Redfin said. So basically, delisting is your home is listed, it's active on the MLS, you don't have a sale going on, you don't have a potential buyer that's going to go under contract. What do? You cancel your listing. Technically, it's withdrawn or it's canceled, and it's off the market. So you're no longer active in the MLS or with these real estate companies as far as having your home for sale. Detroit, Philadelphia saw the biggest drop in home listings, falling both 63%. And according to Redfin, alternatively, listings in Denver only fell 1%. So what we're going to see is different micro economies and different metros across the country will have their own issues going on. The 148% decrease in delistings was across the board, according to Redfin. And as I said, obviously we're going to see different locals and metros have their own issues going along with that. Now, also according to Redfin, the median asking price for a newly listed home that was put on the market last week was $309,000, which is $21,000 lower than 2 weeks prior. So interesting enough, we've seen a huge number of delistings. We've seen anybody who's putting their home up for sale now has dropped. And if it's 321 lower, that's we're talking about probably about 7%, maybe 7.5%. Decrease in value, so that right away people are already going, okay, I want to be a little more competitive. How that's going to play out, we don't know yet, but I would expect further drops. And when looking at new home listings, there still was a 33% decline from the year before. So delistings, big time jumped up. New home listings, so you're going to list your home today, 33% decline there, and $21,000 lower median price than the week before. So it's not like a year before, it's the week before. So we're already seeing a pretty, maybe 5 to 7% decrease in price, listing price, median within a week period or 2-week period. So pretty interesting. Now, here's something that I think is really, really, I guess, hits home with what will happen in our marketplace and why we're going to have this chaos. So when people talk about, mortgage defaults dwarfing the last housing crisis, when 30% of all mortgages will default in the biggest wave of delinquencies in histories, why is that going to happen? Well, there's going to be people who just can't pay, will go into forbearance and won't be able to recover from it just because they financially and physically can't do so. That's going to be a given. But this is very interesting, and I want you to listen to this carefully, all right? In response to the pain the Americans have been hit with the coronavirus, Congress put forth legislation turning this into a tsunami for housing, and the administration seems to be betting that only a few mortgage companies will be swept away. Why on earth would they take the chance when housing market could be swept away too? The administration, which is FHFA, and regulators have put policy in place that could wreak long-term havoc on the entire mortgage market if they don't finish what they started. So this is the key component right here. By virtually eliminating any barrier to entry to obtain forbearance, policy makers have created outrageous moral hazard with potential costs that are unfathomable. To be clear, unlike the last recession when borrowers had to prove hardship in order to qualify for a forbearance plan, a move made to make sure the taxpayers were only helping those who truly were in need, the current regime has opened this up to any and all homeowners with a loan from the GSEs or the GNMA, which is Ginnie Mae programs. So what they're basically saying is back in the last housing crisis, if you couldn't pay your mortgage or were having financial difficulties, you contacted your lender. They had various plans that they would service you with that you could fall into category-wise, and you then had to fill out the 8-page financial, loan request for mortgage assistance form or loan modification form. So you basically had to, your finances, your money in for the month, your money out for the month, that proved that you, for whatever reason, you didn't have the capacity, the ability, whatever, to pay for your mortgage. And that was the starting point. And based on that, you would enter into potential loan programs or loan mods or whatever. Like but you had to qualify. That was the most important thing. What's happening right now is the fact that the lenders are just saying, okay, just let us know. And I know some of the stimulus plan, some of the parties, political parties, were saying they want you to just go on the website and click and say I can't pay. They want to make it easy. They don't want you to qualify for it, and thus it just becomes easy, and that's where people take advantage of it. So you know darn well that people who probably could pay for their mortgages are going to go, you know what, maybe I don't have to right now, and I'm going to click the button, or I'm going to take what's also, I call it like negative option billing. So I've already seen, I guess you could say, evidence of people with letters from their servicers saying, hey, we've already enrolled you in the forbearance program. You don't have to pay for the next 3 months. Oh, by the way, on month 4, you got to give us all the money that you owe us, but we're letting you off the hook for the next 3 months. So, call us if you don't want this to be in effect. You see, so they're putting you in forbearance whether you like it or not, and then it's up to you to opt out of it. And if you don't opt out of it and you get caught, you're going to put yourself into bigger ramifications down the road here. So that's why you got to be careful with what's going on. We've seen this on letterhead from lenders. So this is a really important statement because, again, it's almost like we're reducing the ability to qualify, whether it's for a mortgage or for forbearance. You still got to qualify for it, right? You still got to prove hardship. What's happening here is that we're allowing people just to, well, I don't have to pay because the government told me so, right? I don't have to this because my local government, my county, my president, whatever told me I don't have to do this. So people are taking the easy way out, and this will balloon and snowball into something massive. Thus, the analysts saying, 30% of all mortgages could be down the tubes, and we've got no one to blame but ourselves here. So that's what's going on. So this, I think, is very important, and it's an interesting article, but it just goes to the point where, I don't, like, the expectation is People will lose their homes. The expectation is they won't recover. The expectation is certain mortgage companies will be eradicated and go out of business, and their assets will be taken over by bigger, better mortgage companies in the wake of what's going on here. So that just seems to be status quo for today with respect to what we got going on here. So that's the scoop. Now, when you take a look at the housing crisis and how everyone wants to know how this is going to play out, right? So what's going to happen? How's this going to happen? Will we see property decreases in value? Can I buy my property in 6 months or a year? What kind of deal am I going to get? So everybody's got a lot of questions, and I can appreciate that you have those questions. The problem is we are so early on in this that there really is no answers as of yet. There just basically is thoughts as to where this can go. So I'm going to give you some thoughts right now, but I want to go over an article that I thought was really appropriate for where we are today. So back in the last housing crisis, what typically happened is the people that I guess you could say are the front line, people who get hit by the foreclosures and lose their homes or whatever, are usually the investors. And people might say, well, okay, investors, it's greed. Well, yeah, it's greed, but a lot of investors know how to take advantage or work within the system to profit initially by getting mortgages, by running multiple properties, and they'll be the first ones to sort of work around this. But again, lenders made this available to people, and both parties went in eyed wise open. So I don't really care either way. I don't blame the lenders. I don't blame the investors. It's just what's going to happen in the future, and we'll have to figure it out. But this to me was very telling, and I think this is where the first, we'll say, dominoes are going to fall. The first bricks of the wall are going to come down. So Airbnb. What do we know about Airbnb? All right, Airbnb can be simple as somebody who has extra space in their house wants to rent out a room on a short-term basis to earn extra income to help pay for their mortgage. All right, we know that Airbnb has grown. We know that Airbnb would like to go public, but they're obviously not doing so at this current time. Airbnb has roughly 4 million hosts out around the world, and Airbnb has what's considered something called super hosts. So what are super hosts? Super hosts are people who are hosting on Airbnb that own 10, 20, 30 or more houses that rent them out short term or for a certain period of time to travelers, people who are maybe relocating in advance or working for companies in different locations. So they do a lot of this. So when you take a look at the 4 million Airbnb hosts out there, they estimate that 1/10 are super hosts. That's 400,000 are super hosts. Now, are all those 400,000 in the U.S.? I don't think so, but I could imagine there's a ton of them that are in the U.S. right now. So again, each super host may have 10, 20, 30 or more homes. The average price is $500K, average down payment 7%, and the comment is, this is a ticking time bomb, a repeat of the 2008 fiasco. So this is a segment that is relying on short-term rental income to pay their mortgage. So if you're a super host, you've most likely got financing to buy these properties. Did you buy them the appropriate way? Did you line your mortgage app? Who knows? I don't really care. But I do know that over the past couple of years, there's more financing available for rental properties and specifically for Airbnb properties. And so just the point is that Airbnb has become an industry acceptable form of income on properties right now. So Airbnb is included as a line item with respect to show us your income for your property. Oh, it's Airbnb, great. Typically, you have to have, your property needs to be, to qualify for a refinance, whatever, you got to show probably years worth of Airbnb traffic and income coming into the property. So think about that. Okay, the difference with the last housing crisis, we didn't really have Airbnb. So if you were an investor and you actually had people who were renting your houses, typically they're on leases, so they're not short-term coming in for 2 days or a week or 9 days, whatever, then you've got some downtime. These are people that are paying you a monthly rental amount, and you've got them typically on a lease, so you know that there's money coming in. Whereas in this case, you don't, all right? So if the tourism and travel industry has been virtually shut down, and you're an Airbnb superhost with 30 properties, there's probably only so much cash reserves you're going to have to fill in the gaps as you watch your properties have zero or very, very little income coming in. So yes, Airbnb's come out saying we're going to support our super house, and Airbnb has got some programs in play that have talked about, hey, we can give first responders opportunity to, to stay at some of these locations at a reduced rate and stuff like that. People who are helping with dealing with the problems out there in the medical industry, whatever the environment for the coronavirus. But that's only going to be so many that'll be able to take advantage of that. What about people on the beaches? What about, so you got like all these vacation tourism stuff that's not being utilized right now. These are going to be I call, like, we call, patient zero was from we know where. You're not supposed to say it apparently these days to be politically correct, but foreclosure zero is going to be, like, patient zero on the foreclosure side is going to be Airbnb. And it's going to be Airbnb, it's going to be short-term rentals, it's going to be VRBO, which is vacation rental by owner. It's going to be all the people that, jumped on the bandwagon to create these short-term rental opportunities, which, when you take a look in hindsight, that's a great business. But if you're on the hook for it and you have nothing coming in, this is where it's gonna fall down. So this is really the starting point for all this. It's the short-term rentals. Then, because there's no rent to support it behind the scenes whatsoever, next we're going to have the landlords who have single-family homes. And if you're not unable to deal with your tenant, your tenant either can pay or will decide, or can't pay for truly economic reasons, or will decide not to pay because they can't, or they can, and they'll say, okay, evict me, you go through the process, I don't care. So that's going to be your second wave of foreclosures. Then it's going to permeate into people who really can't pay, who have primary residences, things like that. So it always starts off on the investment side, is where everything falls and crumbles, and it works its way into the mainstream primary homeowner. Well, second homeowners, people who have vacation homes that maybe they don't rent out, but again, in a time of economic crisis, you get rid of luxury items, right? You sell your RV, you sell your motorcycles, you sell your sports cars, you sell your boats, you get rid of your properties or stop paying your properties that aren't pulling in income or at a cost, and you hunker down and you keep your primary resident going. So you kind of got, again, Airbnb hosts, short-term rentals, and you got normal, mom and pop rental, owners. Then you've got the second home vacation people who don't want to afford or can't afford it anymore. Then you get to the primary holders right here. So this is an interesting article, and ultimately what it boils down to is the fact that, our environment allows this to happen. Like any time as a bubble increases, as a bubble rises and it goes up exponentially, we get, what's the word I'm looking for? We get desensitized to the bubble. We're less aware of it, and we want to get in the game. So guess what? More mortgage programs are made available to us with less qualification. We're encouraged to overbuy and overspend because we keep thinking it's going to go up, and at worst case, hey, it plateaus, and if I have to sell it, I break even, and no harm, no foul. Well, guess what, guys? This will be a fairly significant situation. We're not even there yet. We're not even seeing like the first wave of foreclosures to happen and occur because of what's happening. That's gonna be postponed a little bit. But again, my assumption is this: if you're an Airbnb host and you're looking for forbearance and you got 20 properties or 30 properties, you're not going to get forbearance on all those properties. All right, you're going to get forbearance on your primary if you ask for it. Maybe will you fit in the forbearance box as investors? I don't know. I don't really think so. So this is where it's all going to start to crumble right away. And again, it's just the whole process. So what goes on here? Well, you're going to face foreclosure, and then guess what? The hedge funds and the REITs and everybody else, the big investors who are waiting behind the scenes, this was the event that they were looking for to start the process of, okay, let's normalize the business. Housing got too expensive. Let's whack it. Okay, we want to buy it on the way down. They don't want to buy it on the way down. They want to buy it at the auction, where everyday people like you and me can't afford to buy cash at the auction. And guess what? Then now they'll make that property a rental property for their portfolio. All right. So that's where things are going to go. This is the starting point of it. We're going to see more of this, and obviously I'll be talking more of this when time goes on. So hedge funds don't buy retail properties. Hedge funds don't buy properties at the peak of the market or for peak value. They look for deals. They want distress. They want deals. They want off market. And this is how, and they will create this themselves and pick stuff off at the auction, or they're going to pick up what's called non-performing notes or assets from the lenders. They'll assume that debt. They'll buy the debt. They'll buy those notes. Then they'll deal with the homeowner and say, hey, by the way, I can give you cash for keys for your property. You're over leveraged. I'll give you some money. You walk away, or you deed me your property and I'll keep you as a renter, and you can rent the property from me, et cetera, et cetera. So these are things that will happen in the future that will change, once again, change the dynamic of the U.S. housing market, and it'll just make, again, the single family resident is the asset class everybody wants, and these big players will just get their hands on more of them. It's nature. So how do we work around this? Well, we're not massive hedge funds. We don't have billions of dollars, but we can get in front of them with the right technology, the right timing, the right marketing to pick off as many of these properties as possible. Heck, you can supply them to those guys if you want, which is great. If you're looking as a primary resident, you need to learn maybe some of the techniques on how to get ahead of the game on this and make sure you get a house, because I do believe prices should come down. To what point, I don't know yet, and because I do think that the market doesn't. If you're, again, I'm not a financial dude, but I don't engage the hedge funds like this. But if you're a fund with X billions of dollars of real estate assets, you don't want those real estate assets to crash by 20 or 30%, do you? Yes, you're cash flowing, but you still want your values to be high. So by everything going to foreclosure and then buying it at the foreclosure market or off market, foreclosure auction or off market, these are homes that aren't entering into the retail market at lower prices, pushing values down. So there is going to be some control going on to keep values high. That's what I want people to understand, that in theory, when there's more on the marketplace, when prices decline, when there's more foreclosures, that should bring values down. But I can tell you that there'll be powers that we can't control that are going to be working to keep values high and still buying the distressed property. So we got to think about that. We got to be prepared for that in the future. So there's ways to work around this. Obviously, it means being out in the field. It means being a little more savvy in your marketing. It also means understanding what's going to happen and being 2 steps ahead of what will happen to get property at cheaper prices. So if you want to know those things, this is self-promotion, shameless self-promotion. I'm allowed to do it. It's my channel. So if you want that information and understand how we can work around this, drop me a line, send me an email, give me your contact information. I can talk to you about it and train you on and give you the what you need, tools you need to sort of be ahead of this curve. And that's the thing now. Don't wait. Think about this now. I'm thinking about it a year ago, 2 years ago. Don't wait for properties to hit rock bottom and then you're going to buy, because you know what? There may not be anything for you to buy at this point in time. So having said that, I'm not here to scare you. I'm not here to alarm you. I'm just thinking out loud about what could possibly happen, and the fact that where we were 10, 12 years ago in the last housing crisis, there's a huge advancement to where we are now. And I don't think people are considering some of these big players with all their technology being able to beat us to the game. So keep that in mind. Thank you for the views, likes, and comments. Again, reach out to me if you want more information. We'll talk to you later on this week.